Welcome students. So in the previous class we were talking about the say norms of liquidity ratios. In the other way around we call them the rules of thumb also. So rules of thumb we were talking about, and we saw that we have three important liquidity ratios. So I told you that earlier, if you talk about the rules of thumbs till 1991 or a little after 1991 even, so we were following these three rules, and the reason I explained during the previous class, because say if nobody is bothered about the cost, because only there is a single player in the market of manufacturing one product. And now you think about most of the products in the market. Steel was dominated by the SAIL, Steel Authority of India Limited, public sector company. But petroleum, as I told you in the previous class also, even today is dominated by the three public sector companies. You talk about say other, even the public sector companies were manufacturing the say bread, butter, biscuits, like the modern foods. Even the hotel industry, we had many 5-star hotels which were owned by the government, and many other sectors. If you talk about even the electronics, many public sector companies like Electronics Corporation of India and others, they were manufacturing the color TVs. So that sector was there. So it means and most of the public sector companies, they were in a very bad financial position despite exploiting the market fully. Huge market of the 1 billion people, and whatever the product they were manufacturing, whatever the price they were charging from us, we were paying a huge price. And after that also they were the say loss making companies, and they had to be closed down after the this liberalization of Indian economy. So that's a different story. I will not go into that, but as far as the working capital management is concerned, that was very poor at that time. And if you see that even because the total business of this country was dominated by the public sector companies, they never bothered about the cost, and financial cost was just nothing for them, nothing to be considered as a part of the total cost of production. So they were enjoying the liquidity like anything, and they were keeping this high level of the current ratios. Now the level of current ratios, these norms have been revised. One reason was of having the high level of current ratios was the inefficiency of the firms, because they are not able to maintain and manage the liquidity. And second reason was the requirement of the banks. Second reason was the requirement of the banks. I have told you sometime in the past that in India, the major, most prominent and the most important source of working capital finance, if you call it as the short term source of working capital finance, it is the source is the bank finance. Banks are bound to give the say funds for meeting the short term requirements of the Indian manufacturing sector, whether it is a public sector or it is a private sector. Is the most preferred, most convenient and most easily available source of the funds. So everybody resorts to the bank finance. And banks, because there is a requirement, or there is a, you can call it as a stipulation, there is a condition from the government also, that as far as the working capital finance is concerned, banks cannot ask for any kind of the security or any kind of the collateral normally from the borrowers, because their total assets, their fixed assets, their long term assets are already hypothecated against the long term loans. So they don't have anything to give as a security, as a say pledge or anything, you can call it as a collateral. There is nothing to be given. So if the banks are asking for the collateral or security for providing the working capital finance, so firm will be at the say in a very difficult state. Other than inventory, they don't have any security to be given. So if the amount of the working capital is very large, so banks sometimes take control of the inventory of the firms. But if other than inventory, there is no security, no collateral. So since no collateral was possible to be taken for providing the working capital finance to the businesses or to the firms or to the companies, so banks always used to say that the total your current assets, the level of the current assets should be double of the current liabilities, so that any time When our funds become due to be paid by you or by the firm, to be returned by the firm to the bank. So in any case, for example, your cash is not sufficient, your marketable securities are not sufficient, your sundry debtors are not convertible into cash, your inventory is not convertible into cash. So at least you have long-term sources of the funds, and if they are 100% of your current liabilities, it means half of the funds are coming from the bank finance and half of the funds are coming from the your own other sources, long-term sources. So banks funds are safe, so that any time when the bank's funds are becoming due to be repaid by the firm back, maybe the interest or the total amount, so the bank has no problem in collecting the funds back or getting the funds back. So it was their condition that you have to keep the current ratio 2:1, quick ratio this much and super quick ratio this much. But after liberalization, because of say many reasons. First reason was that many sectors were opened up for the private sector participation. And when the private sector participation was allowed and many companies, private sector efficient best companies came into the different sectors earlier reserved for the public sector, then competition increased. When the competition increased, then naturally the inefficient public sector players had to go out of the market, or if not to go out of the market, they were bound to lose a sizable amount of the market. And when they had to lose the sizable amount of the market, in that case there is a you can call it as a threat of sustenance. There is a risk of sustenance, means if they are losing the market quickly in favor of the private sector players in the same sector, so it means there are say so many stakeholders, and the first and the foremost stakeholder was the employees. If the company is closed, if the business concern is closed, then most of the people will come on the roads and unemployment will increase. So they have to run the show somehow. So in some cases they try to compete with the public private sector companies, and when there is a question of competition comes in terms of the two things. One thing is the quality of the product had to be improved, and second thing is that the cost of the production has to go down, and so that the price is competitive, because cost is the basis of price. So if the price has to be kept low in the market of the finished product or the final product, you have to first reduce the cost. So for reducing the cost everything is important. The financial cost, which was totally ignored earlier by the public sector companies, that's why they were having the luxury of keeping this much current ratios. Now they cannot afford to have the very high financial cost. They have to bring the financial cost down, and they realized that in the total cost, financial cost plays very important role. In the total cost, financial cost plays a very important role, and when they realized this thing, so they requested the banks. They as well as all the borrowers, including private sector, they requested the banks that now in the changed competitive scenario of the country, it's not possible to have say huge current ratio, that is 2:1, so that means you have to have say a level of current assets that is double of the current liabilities is not possible. The level should be brought down. We should be able to, or we should be allowed to lower down the ratio. If you want to have some cushion, if you want to have some security, we are ready to keep it more than 1. We don't want that the current ratio should be 1:1. We are ready to keep it more than 1, but not 2:1. So banks agreed that okay, you reduce the ratio, but at least your current ratio, the satisfactory current ratio will be considered, which is 1.33:1. So in today's scenario, 33% of the current assets should be financed from the long-term sources, and remaining funds can come from the short-term sources, including bank finance. So now this is the reason that why the norm of the current ratio has been revised, and now the new norm of the current ratio is 1.33:1. This is the minimum threshold level. This is the minimum norm. If current ratio can be more than this, but if it is to be reduced from this level, if it goes down below 1.3 or 1.33 level, if it goes below this level, firm cannot expect the bank finance. If they don't depend upon the bank finance, then it's up to them. They can have the current ratio that is 0.7:1 or 0.8:1 or 0.6:1. That's their wish. Then there is no problem. this ratio is normally required by the banks. When we go to the banks for seeking the working capital finance as the working capital say loan, CC limit or something, then this ratio is a requirement of the banks that your current ratio should be this, your quick ratio should be this, and your super quick or the cash ratio should be this. So why banks want this 0.33? Because it is a cushion. Any time if the bank's funds become due to be paid by the firm, which they have borrowed for meeting the working capital requirements, if they become due to be paid, so maybe again the same situation can come, that first they will use the cash, then the marketable securities, and then the sundry debtors, and then the inventory. So after exhausting the cash and marketable securities, if sundry debtors are not convertible into cash or inventory is not convertible into cash, at least they have a cushion of 33%. The funds which have come from the long term sources, they would always be available with the firm. So firm will not have the liquidity problem. That's why banks want, because they don't have any collateral, they don't have any security. If the firm defaults in making the payment, what the bank can do? They have not taken any security. They can't sell the security in the market and recover the funds. When we borrow for the long term funds, for the long term say for the fixed assets, even we borrow for buying a house, the house is pledged with the bank. We borrow money from the bank for buying a car. The car is pledged with the bank. When the moment you default repaying the loan back to the bank, they would immediately take the control of your house, they will take the control of your car, they will take the control of the asset, any other asset which we have purchased by borrowing money from the bank. So in this case, the working capital, there is no security as such. So there is no security, so banks want to ensure the liquidity at least. Because if the firm is liquid, if the firm is having sufficient liquidity, then they won't default normally in making the payment. So that's why this cushion is there, that yes, not 2:1, but 1.331 has to be there all the times. Now let's discuss with you one thing, that say how the banks provide the working capital finance in India. What are the modes of providing the working capital finance, because we are discussing this topic. So in relation to this liquidity and the liquidity ratios, let's know about that how the banks provide the working capital finance. So it is because of the requirement of the banks, the current ratios norms were fixed at this level, and now on the request of the industry, because the financial cost is also now the important cost. So the banks have agreed that yes, these norms can be revised and can be brought down, but still the current ratio has to be positive ratio. It has to be more than 1, and the level is 1.33:1, but this is the minimum level, not maximum level. You have to maintain minimum the level of current ratio, that is 1.33:1. Then the quick ratio 1:1, and the super quick ratio or cash ratio, that is 0.5:1. Now because we are discussing this topic and we are talking about the norms or the rules of thumb of the liquidity ratios, so now I will discuss with you that how the bank finance is provided in India to fulfill the working capital requirement of the firms. And I would again tell you that even today 80 to 90% of the working capital requirements of the Indian business or the business organizations are fulfilled by the banks. It's a bank finance which is most popular for providing the working capital or fulfilling the short term financial requirements of the firms. So which is not the case in the other countries. So let's see, first discuss that how the working capital finance is provided by the banks in India. So there are 3 ways. One is the CC limit, which means cash credit limit. In short, we call this limit as the CC limit, cash credit limit. This is the one norm. This is one way of providing the working capital finance. Second is the working capital. Second way is the working capital loans. And third is, this is 1, this is 2, and this is third is discounting of credit sales bills. Discounting of the credit sales bills. These are the 3 norms how the working capital finance is provided by the banks to the industry. CC limit. This is a very interesting concept. Under the CC limit, how this limit works. First of all, a company who needs the working capital finance from the banks, they send a proposal to the bank that we are a manufacturing organization and our total annual turnover is this much and our working capital requirements are this much. So this, say out of the 100% requirements, maybe 10-20% will come from our internal sources, and remaining they apply to the bank that they should be provided the working capital finance by sanctioning a cash credit limit or the CC limit. Bank will analyze their financial position for the minimum for the past 3 years, for which the companies are required to submit their balance sheet, profit and loss account and cash flow statement for the period of past 3 years to the bank. Bank will analyze it, and then both will mutually arrive at some figure that yes, this much of the working capital finance can be provided to the firm. Firm will demand more, bank would then analyze it, bank will apply some cut, and then they would say, if the firm is asking for 100 rupees, bank would say no, we will be able to give you 80 rupees, not 100 rupees. So finally mutually a figure is agreed upon that yes, the total requirement of the firm is say 1 lakh or 10 lakh rupees, 1 million rupees for a period of whole of the year. That is 1 million rupees or 2 million rupees or 3 million rupees or 1 billion rupee, depending upon the size of the firm. So once it is mutually agreed, then bank would say yes, we can provide you the working capital finance. Now the question arises, what mode will be followed by the bank for providing this finance? Firm's approach remains that total funds should come under the first mode, that is the CC limit. But banks want the firms that okay, partly we can give you the under the CC limit, partly we can give you say as a working capital loan, and partly you have to use the bill discounting facility. But firms say tend to use the first mode to the extent possible, that is under the cash credit limit. Now how the cash credit limit works? Cash credit limit, and what is the benefit to the firm and what is the loss to the bank? So cash credit limit, how it works, say for example 1 million rupees limit is sanctioned by the bank to the firm. So in that case, any time when the firm needs funds, say for example they received a truckload of raw material, after say 3, 4, 5 days they have to make the payment of say 2 lakh rupees to the supplier. So they will write a check against that CC limit account. That check will be sent to supplier and supplier will present it to the bank and the bank will clear the bill. Condition here is that whenever the firm needs the funds, they can withdraw the funds from this CC limit account, and if the firm receives the funds on account of sales from the say on account of the cash sales or on account of the credit sales, then those funds should also be deposited in the same account. It is not the case that for borrowing the money you use this account and for depositing your sale proceeds you use another account. No, this is a condition by the banks that withdrawal will also be from this account and deposit will also be in this account. Total operations of the firm, that is the borrowing as well as deposit, will be through this account only. Firm will not maintain any other account in any other bank or any other branch of the same bank. So here in the first case, firm borrowed 2 lakh rupees to make the payment to the supplier, and that 2 lakh rupees the firm has used for a period of say 15 days. After 15 days, firm received some 2 lakh rupees from some credit buyer or maybe on account of the cash sales, and those 2 lakh rupees were deposited in the bank, and that 2 lakh rupees which were withdrawn by the firm 15 days back, these are returned back to the bank. So it means now again the account will come back to 1 million or 10 lakh rupees, because when they withdrew 2 lakhs, account balance has got down to 8 lakhs. But when they received cash from some source, from sale, cash or credit, then they deposited that 2 lakh rupees in the bank, and now again the account balance has become 1 million rupees or the 10 lakh rupees. Now the question arises, for how much period bank will charge the interest, and for on how much amount? Here the beauty of the CC limit is that the firm has used only 2 lakh rupees out of 10 lakh rupees. Firm has not withdrawn the remaining 8 lakh rupees. and that 2 lakh rupees have also been withdrawn or used only for a period of 15 days. So bank will charge interest only on 2 lakh rupees for a period of 15 days, and on the remaining 8 lakh rupees, and for the remaining period no interest will be charged from the firm, from the business. So this is why the businesses prefer the working capital, more and more working capital under the CC limit rather than the working capital loan. Because if it is a working capital loan, if it is a second mod working capital loan, then what will happen? Then what will happen? Bank has sanctioned 10 lakh rupees, 1 million rupees loan for the whole of the year. Whether the firm uses entire 10 lakh rupees, whether the firm uses 1 lakh rupees, whether the firm does not use even a single penny of that, firm has to pay the interest on the entire amount of 1 million rupees and over a period of the whole of the year. So that's very, very difficult for the firms to manage and maintain the loan accounts, working capital loan accounts. So they prefer the CC limits, because under CC limit there is a flexibility. Anytime you need the funds, you withdraw it. For the period you are using the funds, you use it, and when you deposit the funds back, the bank will calculate that this much amount was withdrawn, and for this much period of time this much amount was used. So it means you have to pay the interest to us for this much period of time. So this is a big pressure on the banks. This is a big pressure on the banks that their funds, sometime large chunk of their funds remain unused. If that firm, for example, their actual requirement is 500,000, 5 lakh rupees for the whole of the year, they got a limit of 1 million, that is 10 lakh rupees. It means half of the loan or half of the CC limit was unused by the firms. They have not used it at all, and banks cost is increasing, but there is no return available, and finally bank has to pay the price. So firms insist for the CC limits and banks insist for the loan, but somewhere they have to have some common agreement that yes, some proportion we will give you the CC limit, some proportion will give you the working capital loan. And third is the bill discounting facility. Bill discounting facility, I told you in the previous class also that when the firms sell on credit, so they can use those credit sales as because credit sales are also an asset. Those credit sales will be recovered after the expiry of the credit period. And in India, say for example, the credit period normally ranges from 45 days to 2 months, 60 days. So if some firm is given a credit of 2 months, 60 days, and if the firm who has given the credit, they require the funds. So first they will use the cash available with them in the hand or in the bank. Then they will resort to the marketable securities, they will convert those securities into cash. Then they see that inventory is also not convertible into cash because that's not saleable as and when we want it. So it means now we have only the sundry debtors, that is the credit sales. So if firm urgently need the funds and there is no other source of getting the funds, in that case what will happen? In that case what will happen? The firm will go with those credit sale bills to the bank, that we have this much, say our firm will work out that their financial requirement is how much? 2 lakh rupees, right, for a period of how many days? 1 month, right? They want 2 lakh rupees for a period of 1 month. Their CC limit is exhausted. There is no money left in the working capital loan. So only they have the credit sale bills. With these bills, they will go to the bank and they would say that, look, we have the bills of say 3 lakh rupees. We have sold on credit. This money is coming to us after 2 months, but we need money now for a period of 30 days. So please keep the bills and give us amount, maybe 3 lakhs or 2 lakhs or somewhere in between, how much the bank can give as per the bank's rules and regulations. Then bank may think about it. Bank will look at those credit sale bills. And normally what happens? Banks divide those credit sale bills into 3 categories. These 3 categories are A, B and C. A category creditors, B category creditors, sorry, not creditors but debtors. A category debtors because of credit sales, A categories, B category and C category. Who are the A category of the debtors? Who have bought on credit, who have a very good financial reputation in the market. For example, there is some supplier who is manufacturing say some part of a car, and he is a regular supplier to the Maruti Suzuki. Suzuki Motors has a very good reputation in the market, and if some supplier, he is supplying to Suzuki also, he is supplying to say Hyundai also, and he is supplying to some other company which is not that much credit worthy, for example General Motors. Now total bills, some sales to Suzuki, some sales to Hyundai Motors, some sales to the General Motors. So those bills will be, or maybe he is not supplying to General Motors, maybe some other company which is less credit worthy. Now those total bills will be divided into three categories by the banks. Bank would say, for this A category of bills, bank has no problem, because bank knows that these are fully secured. On the due date after 2 months, Suzuki can never afford to default because of their financial reputation and position in the market. So if we discount these bills, we buy these bills, our investment or our loan is secured. Even in case of the B, it is also secured, because this company is also very good company, but there is some doubt in the C category of the bills. But here what happens? A category of the bills, companies also don't want to discount because they are fully secured. C category of the bills, banks don't want to buy. So finally the X lies on the B category of the bills. B category of the bills which are moderately secured, banks buy, and if there is a requirement for the company, funds are not sufficient under the B category of the bills, then they would like to sell the A category of the bills also, but C category of the bills bank will never discount. So in this case, under the bill discounting facility, bank will purchase this B category and part of the A category of the credit sale bills, they will keep these bills as a security, and up to 80% of the total amount of this B and A category of the bills, bank will immediately give to the firm. 20% is kept by the bank, and that will be settled on the due date when that credit buyer or the sundry debtor will make the payment to the company. So in that case, either the company will receive the payment and then they will make the payment to the bank, or sometime company informs the debtor that to directly make the payment to the bank, we have already got the bill discounted. So when the bank gets the payment from the debtor, then bank will settle the account. Bank would say now the total receipts are 100%. Say the bank had given, for example, 2 lakh rupees. So 2 lakh rupees is just the 80%. So they will get the bills for 100%. So out of the 100%, bank would say 80% is already given to the firm. Now out of the 20%, bank would say deduct its first interest, charges, commission and administrative charges, and if any amount is left, then that will be transferred to the main firm, the seller. Otherwise that 20% will be used by the bank to recover their interest, their commission and their administrative charges. If some amount is left, then still the firm will get. So for example, the 10% works out as the total interest, administrative charges and commission. So it means the remaining 10% will be given by the bank to the firm. So in this case, firm immediately could get 90% of the credit sales, they could immediately get from the bank under this facility. So it means they had to lose 10%, but they could get the funds, they could save their reputation in the market, and they could maintain the liquidity also. So under this system, under the discounting of the bills, credit sale bills facility, this is the third source of the working capital finance, and first is the most preferred for the firms is this. Banks want this, and in between then they arrive at some common figure, and these days now what is happening that partly the bank provides the CC limit, partly bank provides the working capital loan, and partly banks provide the bill discounting facility to the firms who need the working capital finance. There is an instruction from the RBI to the banks that loans of 10 crores means working capital requirements of 10 crores and above. If the working capital requirement of any firm is of 10 crores and above, then in that case 80% should be given as the working capital loan and bill discounting facility. Only 20% should be given as the CC limit. So it means 2 crores can be given as a CC limit, 8 crores worth of rupees or above, if the total requirement is more, has to be given by way of working capital loan or by as a bill discounting facility. But what is happening? If the banks start imposing this kind of the discipline on the business firms, then what happens? They expect to lose the good customers from their account, or means the good customers who have a good credit rating in the market, they will shift from current bank to the new bank. So they are not banks are not able to implement this threshold level of the 10 crores and above. And this is not the 10 crore and above only. RBI says that over a period of time, this threshold level of 10 crores should come down. It should be somewhere 7 crore, then 6 crore, 5 crore, through 2, 3. Slowly and steadily, the approach of the RBI is, the policy of the RBI is that total working capital finance from the banks going to the industry should be in the form of loan and the working capital loan and the bills discounting facility. CC limit should be totally abolished, because in most of the countries this CC limit is not there. This is largely in India. This is the most prevalent source of the working capital finance, most popular source of working capital finance only in India, not in the other countries. In other countries, for example, I tell you the story of US. In US, CC limit is not there. Working capital loan is there, but under the working capital loan also, if you want to borrow working capital loan from the bank there in US, then what they say, what they do, what are the conditions? That if the total requirement, working capital requirement of the firm is say $1 million, then bank would say half of the amount, it means half a million, 5 lakh rupees, you deposit in the other account, and that 5 lakh dollars will be kept as a collateral or as a security by the bank, and no interest will be paid on that 5 lakh dollars. Once you have deposited that 5 lakh rupees, then bank would give the loan of the $1 million. It means, in fact, what is that loan? In fact, the bank has given only $500,000 loan, not of the $1 million loan, because $500,000 the firm has already given as a security, as a collateral to the bank. And as far as the interest is concerned, the firm is not getting any interest on their own 5 lakhs, but bank is charging the interest on the total $1 million. So how expensive the working capital finance is in US? How expensive the working capital finance is in US? Hardly the firms resort to this source of the working capital finance in US. Businesses never use bank finance as the source of the working capital finance in US. They use other sources. They use say other financial institutions. They use the public deposits. They use the intercorporate borrowings. They use the factoring. Factoring is very popular source in US. They use the say forfeiting. They use the nowadays we are talking about the derivative finance, which is very, very popular. So they use the derivative finance. So other sources firms use. That's why the other sources are very popular in US or in the other countries, not the bank finance. It's in India only the bank finance is the most popular source of working capital, because it is the cheapest, safest, most secure, easily available source of the finance for fulfilling the working capital or the short term requirements of the firms. In other countries, normally the working capital comes in the form of the working capital loans, not under the CC limits. So here I would like to remind you that look at the efficiency of those companies. In India, we never bothered about the financial cost till 1991, even some years after that, till 2000 even. Those companies who are paying very heavy financial cost, they are paying a very heavy labor cost and other kind of the cost also. Taxes also are again high in those economies. Despite that, they are the best firms manufacturing the best products in their own country, and they are distributing that product to not to their own country's market, but to the world markets. For example, you talk about say General Motors. General Motors is not supplying cars to US only. They are in India. They are in the many countries of the world. after facing so much of the problems, their financial cost is high, their labor cost is high, their other input costs are high. Despite that, they are so competitive, they are so efficient that they are able to say sell the cars in the Indian market also. And in the Indian scenario, look at the Indian business situation where finance is so easily available, labor is so cheap, raw material to a larger extent is easily available, but still we are not able to compete in these markets. So, because of this reason, because of this problem, the Indian business has not been able to come out of its shell, could not grow, could not face the competition, and because of that, say we are still dependent upon the multinational companies for most of our day-to-day requirements. Our cars are coming from multinational companies, our electronics products are coming from the multinational companies, our even steel is coming from multinational companies, our cement is coming from the multinational companies. So we have not been able to do much because of some defective business models which we followed in the past, but we expect that in future we will be able to improve the situation and many Indian companies would become the world players. So I will stop here in this class and remaining discussion on the different liquidity ratios of the steel sector companies like SAIL, like JSW or JVSL or TISCO, all their liquidity position, their current ratios, I will discuss with you in the next class. Thank you very much.